Welcome to Inside Out, a show where we focus on individual stocks with in-depth analysis. We deep dive into financials, and we also tell you about the key risks, valuations, and triggers going forward. Hey, Sonal.
Hey, Nigel, and not only that, right? It's not only going to be the metrics that Nigel just mentioned. We are going to ask the questions that all the investors and viewers want to ask. So let's not waste any time. Let's get to our first stock today. Nigel, what is on deep dive for you?
Well, the stock that we're focusing today has been a relative outperformer from the metals pack. And if you just compare what the stock has done in comparison to what the index has done, and in 2023 so far, it's been a rank outperformer comparing it with the key indices. The company is involved in the manufacturing of two key products, namely stainless steel tubes and carbon steel pipes. Now, on the stainless steel side, it's further broken down into seamless tubes and welded tubes, while on the carbon steel, well, it's broken down into ERW, 8-saw, and L-saw pipes. The user industry includes oil and gas, which covers petrochemicals, refinery space, and is bulk of their business. And it also finds its application in nuclear, thermal, and solar power plants. Another sector which has come to fore is the water space, where we can see a massive spurt in orders due to the country's focus on the Jal Jeevan mission.
Okay, all right. Thank you for explaining what the company does, Nigel. So it's a good time to get in the management and understand more about the business as well. We are now joined by Mr. Manoj Sanghvi, who's the business unit head at Ratnamani Steel and Tubes, to take some questions. Mr. Sanghvi, thank you for joining us. Welcome to Inside Out. And I want to begin by asking you, for both your segments that Nigel mentioned, what is the current utilization levels here, and what is the market share domestically, and what is the global market share as well in the special steel segment?
As you know, we have two divisions, stainless steel and carbon steel. Stainless steel with the capacity of 50,000 metric tons, and carbon steel a capacity of 5 lakh metric tons. 60,000 which is coming up, which is in Rajasthan. So in all, carbon steel capacity will be 5,60,000 tons. Utilization levels, if I talk, it is between 50 to 80% depending on the product line. At an average, the utilization is close to 60%. Our market share for stainless steel tubes and pipes within India is 30 to 40% depending on year, whereas globally, if we see for stainless steel, our market share would be less than 10%.
Okay, all right, Manoj, we got the numbers on the stainless steel tubes business, but what is your market share in the carbon steel pipes segment?
Carbon steel domestic, our market share would be between 15 to 20%. Internationally, less than 5%.
Mr. Sanghvi, you know there have been measures to protect the domestic industry, but how much of the domestic demand is wet my imports for both of your divisions?
First, I'll take up stainless steel. Government has come up with a few measures, one of which is Bureau of Indian Standards, wherein to prevent substandard tubes and pipes from coming in. So now any country or company who wants to supply stainless steel tubes and pipes in India needs to have the Bureau of Indian Standards approval. So that step has been good for the domestic industry, because there were a lot of substandard tubes, pipes coming in the country. So by way of that, now any company who wants to supply to India will have to get approved with BIS. So that is one measure. Another measure recently, which the government has come up with anti-dumping on some companies in China. Of course, there are few companies which have got zero duty. However, in the long run, we feel that both these measures will help the domestic industry for stainless steel tubes and pipes. For carbon steel tubes and pipes, there is not much import coming in the country because of the steel policy, wherein the local value addition is required in the country. So we are not seeing much imports of carbon steel pipes in the country.
All right, Manoj. So implementation of BIS as well as putting duties in place, that's what's protected the stainless steel market to some extent. But how much of the domestic demand is catered to by imports?
So stainless steel would be anywhere between 20 to 25% imports. Carbon steel less than 5% at the moment. I'm talking about big projects, line pipes, cross-country pipeline, where so any project above 50 crores, government has got a steel policy which says that local value addition is required in the country.
Okay, now let's understand your end user demand as well. How much of your business is coming in from oil and gas sector? How much from the other industries?
It may vary from year to year because there may be a year where oil and gas projects are more, and when they are more, because of the margins, we are more inclined towards oil and gas. But then, say if I take an average of 5 years, we would be close to 30 to 40% for oil and gas industry, another 20% for power industry, say 10 to 15% for water industry, and balance all would be then automotive, then aerospace and defense, chemical industry, pharmaceutical industry, shipbuilding industry, other industrial products. So that's the breakup. So majority still 30 to 40% is oil and gas.
Mr. Sanghvi, we have a lot more questions, so we'll come back to you. But interesting points there, Nigel, right? But I'm guessing between the two segments, that is stainless steel tubes and carbon steel as well, there'll be a margin difference as well. Can you give us some idea there?
Well, that's right, Sonal, bang on. On a blended basis, the margins are around 20% for stainless steel tubes and approximately 15% for carbon steel pipes. So broadly, the difference between the two segments is around 500 basis points. Now, within stainless steel tubes, seamless is more profitable, while within carbon steel pipes, LSAW is more profitable. Just to drive home the point or get to the point, water projects, they use 8-saw pipes and they can drive the top line, but margins, they'll be relatively lower.
Okay, so that is about the margin split. But Nigel, one of the reasons for the relative outperformance that you spoke about at the beginning is the past quarter. It was strong, right? So run us through that aspect in terms of financials.
Well, the past quarter, their product mix and operating leverage led them to delivering their best ever quarter. But they clocked in EBITDA of close to around 200 crores in a single quarter with margins in high teens. The problem is sustainability will be the key from here on. Even on a year-on-year basis, they've almost done revenues which is equivalent to what they did in the entire of last fiscal, with margins of around that 16% odd. Scaling up from here on is going to be very, very vital. Well, Manoj, let's come across to you. Let's focus on the revenue growth first. It's been a very, very good showing from you in FY23 so far. But what do you end this year with in terms of revenues? And on that sort of a high base, what is the growth trajectory you're looking for in FY24?
So this year, yes, of course, our budget was also below 4,000, but we think that we will surpass that. We will close somewhere close to 4,200 crores, plus minus 100 crores. That is what it seems like at the moment. For next year, we feel 10% growth should not be difficult considering the orders what we have in hand. So as of now, when we speak, we have close to 3,100 crores of orders in hand. So which maybe 500 crores will not be executed next year and will go a year after. But 2,500 to start the order book with 2,500 crores, which is going to go in next year, we don't see that 10% growth should not be achievable in next year.
Okay, so that is how you're expecting business to grow as well. But since stainless steel tubes could contribute less and higher proportion of water projects could dilute margins, tell us what is a sustainable range investors could work with?
To answer your first question, which is the mix, the product mix, stainless steel going down. This year, if we see stainless steel will be close to 30% of our revenues. Next year, when we do 4,600 crores, again, stainless steel will be 30% because as we are growing the carbon steel business, simultaneously the extrusion press, which is installed, the ramp up of capacity for stainless steel products is also happening. So we don't see that margins will get affected. Of course, we will, because the demand for oil and gas carbon steel pipes is less. So we will have more orders in carbon steel segment for water. But we should, in the end, with all the product mix what we have, we should end up between 14 to 16% margins, EBITDA margins.
Okay, we get that point. But Nigel appears they are on a strong footing as per the management commentary as well. But tell us, what are the triggers in terms of growth from here on?
Well, Sonal, three big triggers for growth from here on. First up is the already announced expansion of SS Pipe's cold finish line, which is basically value addition, and also 8 saw capacity at a capex of close to around 400 crores. That's the factor that could drive growth beyond FY24. They've also acquired 53% stake in Ravi Technoforge at an acquisition cost of around 98 crores, and they'll be upping their stake by close to around 27% in FY25. And finally, they have good visibility as the order book has swelled up to around 3,100 crores, but bulk of this is attributed to domestic carbon steel pipes.
Okay, important triggers, so to say, for the company. But Mr. Sanghvi, let me come to you, and we want an update on the expansion plans for both your divisions. What is the capex and what is the total asset turnover on this investment that you'll be making?
So we have two expansions going on, both each for each division. For stainless steel, if I come to, we have an expansion of about 180 crores. We are increasing our cold finishing capacity by 1,500 tons. So overall, our stainless steel seamless capacity, which is 30,000 tons, might not go up because we are doing further value addition. Rather than selling the hot finish pipes, we want to do further value addition at our end and supply. So this 180 crore stainless steel at peak, it can do 1.5x of 180 crores. Whereas the other expansion what we have is for carbon steel pipes at a different geographical location. So there our investment will be close to 200 crores, and the asset turnover ratio for that would be 2 to 2.5 times.
All right, Manoj, plugging in the numbers, on this capex, you can do approximately 700 to 800 crores of revenues?
Yeah, 600 to 800 crores.
Okay, 6 to 800 crores. What is the revenue potential of that newly acquired Ravi Technoforge? And also, if you could tell me, at what valuation will you acquire the remaining 27%, which is due in July 2024?
This year, Ravi will be doing close to 250 crores. Next year, we have a growth plan of about 25 to 30%. So anywhere between 330 to 350 crores is our target next year on revenues for Ravi Technoforge. Yes, of course, this Ravi Technoforge, they manufacture rings, which is supplied to bearing manufacturer. So we see that the business is scalable and the growth or the numbers what we are projecting is possible. And with the infusion in the company right now and the expansion, we see that we can reach a max revenue of 500 crores a year after. So that's our 2 years plan for Ravi Technoforge. On the acquisition of balance 27%, it is a multiple of earnings which will come to a EV, and after deduction of debt is the value what we will be paying for balance 27%.
Well, Manoj, on Ravi Technoforge, we got it. You will scaling the business to around 500 crores. But you didn't answer the other question. What will the remaining 27% stake in Ravi Technoforge be acquired at?
It is a multiple of the earning. I would not like to mention the multiple at the moment, but yes, it is a multiple of EBITDA to be paid at FY24 numbers.
Well, Manoj, so you have some capex that will come on stream. You're talking about ramping up Ravi Technoforge as well. So simple question is, can you do 6,000 crores of revenues by 2025?
See, with the two expansions and with Ravi Technoforge being consolidated with Ratnamani Metals and Tubes, yes, 6,000 crores is at peak, considering the market situation and the steel prices remaining same, what we can achieve. So yes, it is very much possible, but it depends on two major factors, which is prices of the commodities and the projects. We are a project-driven company. So as far as the projects are there, yes, 6,000 can be easily achievable.
Okay, so Nigel, as we always do, let's wind this segment down with the shareholding pattern, valuations as well for the company.
Okay, let's do that then. Promoter is a majority shareholder with around 60% stake, but there are lots of marquee names in there. Now, on a forward PE basis, it trades at a premium in comparison to some of its peers, but keep in mind, it's relatively larger in size and it's also a debt-free company. Well, Manoj, since you have a clean balance sheet, you'll be looking at some organic growth, and that's the buzz. Also, will it be domestic or will it be international that you're looking at?
Yeah, so as such, we have there's no debt on the books. There's hardly any debt, but net debt is zero. Your first question, yes, there's no debt, and of course, company is generating cash. So we are looking for inorganic growth in similar industry. Maybe backward because once we ramp up the stainless steel pipe making capacity, we are dependent for a lot of raw material from European countries or Japanese manufacturers. So in a long run, yes, we might think of going backward or having an inorganic growth in that sector. But at the moment, we are waiting for our extrusion press first to ramp up the capacities, then to manufacture the high alloy grades. Once we do that, yes, we are looking for inorganic growth. Yes.
That was a deep dive into Ratnamani metals and tubes. Thank you, Nigel, for explaining that to us. But it's time for a short break and we'll come back with another stock.
CarTrade Tech, that's the one in our Swotlight segment. Sonal will be getting you a detailed analysis on that. You don't want to miss this. Welcome back. You're tuned into Inside Out here on CNBC-TV18. Well, it's time to focus on our Swotlight segment. Sonal, what do you have for us today?
Well, Nigel, I wanted to look at a company where it is spoken about, but the business is not understood so well. So CarTrade Tech is something that came on my radar. It listed in August 2021 at 1,600 rupees per share at a discount to the issue price. But since then, it has seen a one-way decline for the stock price as well. Something that we saw with all the new age companies. So what does the company do? If someone wants to buy or sell a car sitting at home or sell an old vehicle, the company helps. It is a digital automotive platform or an aggregator that facilitates buying and selling of new and old vehicles between customers, OEMs, dealers, banks, insurance companies and all the stakeholders which are involved. And it has many platforms or brands under which this works. There's Carvale, Bikewale, there's CarTrade, Shriram Automall, there's CarTrade Exchange, Adroit Auto and AutoBiz as well. Now, Carvale, Bikewale and CarTrade, it is used by potential car or bike buyers to research and compare a wide range of available options and also to connect with dealers, OEMs and other partners. How do they earn money here? Now, company here monetizes these platforms by paid ads and marketing campaigns. These campaigns come in from OEMs, their dealers, banks, insurance companies and other financial institutions which put out ads on these websites. Shriram Automall or SAMIL. This is where the company acquired it in 2018, and CarTrade Exchange. They are platforms where company facilitates sales of pre-owned vehicles, and here it earns commission and fees from the auction and remarketing services. Lastly, it provides ancillary services such as valuation, there's inspection and registration via Adroit Auto as well, so a whole host of services.
Well, Sonal, so many services and business segments as well. You said the stock has seen a sharp fall. Did it have anything to do with the financials?
Well, since the time I've seen this sharp fall in the stock price as well for many new age companies, but that is not something that we've seen in the revenues, so to say. Revenues have been between 250 to 300 crore rupees for the company. On 9 months basis, it is averaging around 270 crore rupees. These companies report adjusted EBITDA margins, which many long-term investors stay very wary of, right? For this company, adjusted margins have been around 28% as per the investor presentation for last 2 to 3 years. Now, when it comes to profits, they made 103 crore rupees in FY21. Then there was a massive loss of 121 crore rupees. And now in 9 months, it's back to profits of around 23 crore rupees. Quarter 3 and quarter 4 are usually stronger quarters for the company. And also a positive is that it is a debt-free company with a cash balance of close to 1,000 crore rupees. So that works in their favor.
Well, that's right. Having cash in the books always gives some kind of support. But what are the other metrics we need to track for this company? Also tell us some triggers here, possible things an investor should evaluate while looking at the company.
So it's a website, right? So the number of visitors on the website and how many of them actually convert to a customer is important to track. from levels of around 27.1 million unique customers in Q1 of FY22, then going up to around 30 millions that is in Q4. Company in the last quarter saw unique customers of around 35.4 million, and that looks like a sustainable range. Out of this, organic unique visitors were at 87.6%, and the rest is from actually paid sources. In terms of possible triggers or important factors, company launched AppSure. This is to sell their cars via franchisee network for used cars. It has 57 outlets at 34 locations where company takes 60 days to buy a vehicle, refurbish and sell it. It is a very small part of revenues right now, but analysts have been very bullish on it because they expect future revenue growth for the business to be driven by faster growth for AppSure. However, company in Q3 said it will take another quarter or 2 quarters to focus on revenues and margins for AppSure. The second is Shriram Automall or SAMIL. This is an acquisition and a captive B2B auction platform. This is for the repurposed inventory of Shriram Transport, which is then auctioned on its platform. Auction volumes went up 9% in 9 months, but they were weak in Q3, and that's the reason why everyone called it weak numbers. So this is an important segment to track for the company.
Okay, interesting. What are the key risks though in this case? Not growing profitability is one for sure. Also, valuations and shareholding pattern. Interesting.
Okay, yes. So that's been a big worry for investors, right? For new age companies to grow profitably. They are also unable to break into Maruti that accounts for 43% of cars sold in India in FY22. So this will be an important account. Additionally, while analysts are bullish on AppSure, but this thing is not gaining so much market share. In terms of valuations, price to sales is what I'm looking at right now. It has come into 1.3 times versus 4 times at the time of listing. That's the kind of price damage we have seen. Interestingly, promoters do not hold any stake in the company, and some big names are a part of the shareholding. Mutual funds at 3.21%, we have AIFs at 2.12%, FDIs at 52%, and the FPI category has it around 20.55%.
Well, Sonal, that was indeed a very, very interesting piece and some very, very good information that we had on CarTrade Tech. But we've completely run out of time on this edition of Inside Out. It's goodbye from Sonal and myself.
But do write to us and tell us the companies you want us to discuss and you want to hear about. We'll feature these on our show. Thanks a lot for watching us today.